Hello everyone, welcome to today's US Open live webinar. It is Tuesday, June the 13th, 10 minutes before Wall Street opens as always. I'm your host, Nikos Zavouras, Senior Market Specialist at FXCM. It's been an eventful week so far. China's central bank cut key interest rates to support economic growth following a series of disappointing data. Wages in the UK increased further, keeping pressure on the Bank of England for more tightening, while on the latest economic data released less than an hour ago, US CPI inflation moderated in a report that maintained the status quo and prospects for a pause by the Fed. All that, of course, is ahead of the central bank bonanza we expect over the following days, starting with the Fed on Wednesday, moving to the European Central Bank on Thursday, and the Bank of Japan following on Friday. Before we get into all of that, however, as always, please read carefully through the risk warnings and the disclaimers, and then we will get started. As always, please remember that anything discussed here does not constitute investment advice and should not be construed as such. If there are any questions or you want to share your opinion with us, feel free to type in your comments on the chat box. So we have Euro USD on our screens, and let's start from the latest developments. US CPI inflation decelerated to 4% in May. That's the lowest in more than 2 years, and core moderated to 5.3% year over year, in the smallest increase in 1.5 years, around 1.5 years. Now, this data reinforces the case for a Fed pause. It will likely allow those who are in favor of that to stay on the sidelines, and I don't know if it will do much to alter the opinion for those who wanted to hike again, but it could perhaps help them move to that direction. Of course, you can find more on our video. We have already posted a video with a preview of the Fed decision and the reasons why to hike or not to hike. In any case, market pricing is for a skip at this meeting, which is on Wednesday, but there is still expectations for another hike in July. Now, Euro USD has been in a recovery mode due to this policy differential, as the European Central Bank has been more hawkish and makes its decision a day after the Fed. And it tries to retake the critical confluence of resistances in an area we have highlighted before. This includes 38.2% Fibonacci, the lower border of the Ichimoku cloud, and the 200-period EMA. Today's data does allow, give it the chance to surpass that level, and that could give it the opportunity to resume its uptrend, but a strong catalyst would be required for exiting the cloud at around 1.099, 1.097. On the other hand, we see that it faces pushback again on this crucial resistance area, and as long as it cannot move above it, there is risk for lower lows at 1.0634. And the 2023 lows at 1.0481 are kept in play, but again, we find it we still consider it difficult to see sustained weakness at this level. Of course, as we said, we have central bank decisions from both banks tomorrow and the day after. So any technical determination here would be probably a little bit far-fetched. And we will talk about those two policy decisions towards the end of the session, as always, in the What's Ahead section. Now let's move over to GBP USD, which also is helped by today's inflation data from the US. However, earlier in the day, we got unemployment figures. Unemployment from the UK, unemployment is down to 3.8% for the February-April period. And more to it, average weekly earnings rose to 6.5%. And if we exclude bonuses, they surged 7.2%. And that is the largest growth seen outside the pandemic period. Now, these data make fighting inflation harder and keep pressure on the Bank of England to hike rates again. Meanwhile, the consumer price index, although it decelerated in April, headline, the overall report was concerning as core jumped to 6.8% and the biggest increase since 1992. So there are increased prospects for more tightening by the Bank of England, and the pair reacted higher to the UK jobs report, trades above the 200-period DMA, and the daily Ichimoku cloud, having defended the critical 38.2% FIBO of its previous advance in late May. Now, this gives it the chance to set new 2023 highs at 1.2680, although 1.2948 has a higher degree of difficulty. On the other hand, the pair is having a tough month, and there is still risk of sub EMA 200 moves here at around 1.245, 1.2456, but a breach of 1.22 but again, we could expect a catalyst for further decline to 1.2273. Sorry, that would need a catalyst. Now let's switch gears and move to US oil. And here we got quite a few developments. Today we got the People's Bank of China cutting the 7-day reverse repurchase rate by 10 basis points, injecting 2 billion yuan into the financial system. The move came after last week's poor inflation data and the lowering of deposit rates by commercial banks. The central bank had also cut the reserve requirement ratio by 25 basis points in March. So we see an effort by authorities to stimulate the economy following those poor results that have cast doubt over the recovery of the world's second largest economy, and more stimulus could come. Now, US oil has been dropping over the past few days due to the poor results from China that we talked about, but now this keeps it very vulnerable to the new 2023 lows and the 62.42, 61.72 regions, which is highlighted here. However, we continue to see sustained weakness there as difficult given the expectations for tighter oil markets. However, today we see significant rebound by US oil, finding support from the action by the Chinese central bank, and also by their enforced prospects by a Fed pause, and the fact that OPEC maintained its oil demand outlook for the current year. This gives it the opportunity to try to reclaim the 200-period EMA at around 72.20, but its recent visits above it have been short-lived, as we can see here from late May and in early June. Once again, though, the central bank decisions will probably affect, mostly the Fed will probably affect oil prices as well. And as the US indexes, the US stock market now opens, let's move to the NASDAQ 100. The tech-heavy index is on a roll and sets new year highs, helped by prospects of the Fed staying in the sidelines, as we've already talked about, and the impressive performance of big tech over recent months, mostly due to the AI boom. It moves closer to the 15,274 resistance, although we remain cautious for 16,771. On the other hand, the move is overextended and a pullback would be reasonable, but we struggle to see it below the 200-period EMA at around 13.95. And of course, as we said before, it is well protected below that 200-period EMA. So that's from the technical. Now let's go to what's ahead. Let's start with China, because we expect industrial production and retail sales on Thursday. In April, both figures had expanded significantly, but far less than markets wanted. Also, the central bank decision on the medium-term lending facility from China this week, these are expected. And of course, then we have the big banks. The US Fed is on Wednesday. Once again, you can find a video with a preview of that decision and really explain the reasons as to why to hike or stay on the sidelines. In any case, it's reasonable for policymakers to skip a hike at this meeting in order to assess incoming data, given the massive amount of tightening they have already provided and its lagging natures, and of course, credit tightening. And that is what markets price in currently, rates staying at the current level. On the other hand, inflation is still far from target, despite the new deceleration we saw today, with wages are elevated and the labor market is tightening. So the most likely scenarios for a hawkish pause, where officials will not talk about terminal rate and will talk about more policy firming, that will keep the door open to that. Of course, we'll be waiting to see if there are any dissenters on the decision, and of course, surprise that cannot be ruled out, but today's data diminishes, I think, this likelihood. And of course, we expect the press conference and the updated projections, the so-called dot plot, around on how the Fed officials see the rate outlook. Now, just a day after that, the European Central Bank picks up the baton, has clearly pointed to more hikes and has maintained a hawkish stance. However, the latest data from Eurozone create an interesting backdrop. Preliminary figures have revealed a significant deceleration in both core and headline inflation measures. The final print is due on Friday after the decision. While the economy unexpectedly contracted by 0.1% quarter over quarter in the first quarter, while Germany has entered a technical recession. And then we have the Bank of Japan on Friday. This will be the second meeting under the new governor. Does not seem to want to be ready to move away from the ultra loose policy settings. He had recently warned that the bank would patiently maintain this stance. So, however, expectations for an eventual normalization of policy are building up. So it will be interesting to see if we get more insights as to such prospects, their timing, and how could the Fed could come about delivering on that, if of course that is where it intends to go. That's it from me. We won't have another US live session this week. The next one will be on Thursday of next week at our usual time. Thank you for joining me.